This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name's Andrew Page, founder of strawman.com, and I'm joined by Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
Good to have you back, mate. And Claude Walker from ethicalequities.com.au.
Hello, everyone.
G'day, Claude. Guys, big agenda this week. What are we going to talk about?
I'm going to talk about Webjet. Because I bought a few more shares today.
Okay.
Nice, one you followed for a while.
I've followed it for many years. Quite a few of those without owning it. So I recently started gradually accumulating the stock.
Okay, great. Well, I'm keen to hear about that. And Matt, what are you going to talk about?
I'm going to talk about kind of selling process and more specifically about a company that I sold a while back, Class. So we talk a lot about buying, going to go through like the thesis of a sell.
Okay, nice.
Yeah.
I like it.
Excellent. And I believe, Andrew, you might want to kick us off, I guess. Going to start talking about property and your love for Australian property and how you like investing in it.
I thought we'd mix it up a little bit, and what prompted me was there's always articles in the press about property. I mean, Australians love their property, but it feels as though it's taken a particularly bearish turn of late, and I guess that aligns a little bit with my way of thinking, and I thought, well, let's talk a little bit about that, and I guess just to bring it back to our topic of choice, how that relates perhaps to the share market and investing.
Yeah, nice.
Awesome.
All right, give us the pitch.
Oh, I'm first up.
Yeah.
Okay. Okay. So let's start. Let's get a couple of things out of the way here. Property is a phenomenal investment. If you go back, I actually saw a chart today doing a little bit of prep that since 1926, property in terms of its average annual returns is like less than 1% away from what the share market has done. It's been a really, really great long-term investment, and I think
I've actually seen one that property outperforms shares.
I think over the last 20 years it has outperformed.
This was over 150 or something.
Oh, 150.
Yeah. But is it that it required that you reinvest all the money into the thing, which is quite difficult to do with like one house? But that was the argument. But anyway,
the point stands. The point stands. And people will, there's property. People love property. There's people who love shares, and I just don't want to get into that argument. I think property is great. I think it's a wonderful investment. But also here, I wanted to distinguish between buying a home, buying shelter, and buying property as an investment. We're an investment podcast, so I figure let's talk about that particular dimension of it. And I guess where I come from with this is that no asset, no matter how wonderful, to quote Charlie Munger or Buffett, one of the two, it's not worth an infinite amount.
Yeah. And
things have really cooled off here. I'm going to focus particularly on Sydney, which is where we all live, and I think we're closest to it. And it's also easily the biggest city in Australia, and I think Australia and Melbourne make up 40% of the whole population. So
it's a big city. Like if you look at the US, right, it would be the second and third biggest city, Melbourne in Australia. Like New York's the only city in the US bigger than those two cities.
I didn't know that.
Yeah.
Okay.
It's a big place.
So and like the share market, you can have a share market that's going really great, and there are stocks within that don't perform well, and vice versa. And obviously that is the same with property. So we have to necessarily generalize here. And I guess I wanted to sort of weigh into this. I think you sort of seem to have two different parties here. There is those that it's sort of like stronger for longer. It's always going to go up. One of the things that kind of drives me a little bit mad is that there's this sort of saying out there that property, or this mantra almost, that property doubles every 7 years. And it seems patently absurd that is even mathematically possible over any reasonable time frame. Of course, it has actually done that, and probably then some in recent history. So you've got to give a nod to that. And on the other side, you've got the perma-bears. You've got the people who are always saying it's a disaster, it's going to crash in a heap, and those people have been around for a long, long, long time, and they've been really, really, really wrong. So I don't want to get into either extremes. I'm going to put my hand up. I've been bearish on property for a while now.
But if I might interrupt, then when I first started to hear your caution about property prices,
started subscribing to my newsletter.
I think you're been more or less proven right. I think that was around 2014 that you were sort of piping up to me saying that you thought that it was expensive. Well, it looks like we're on track that 5-6 years later, property prices will be around the same levels, that's assuming that the current falls continue.
Yeah, I think this is the thing. I think there's more nuance than either, doubling every 7 years and like crashing 30% or so. I think I really sit at the...
I guess they're still up quite a bit from that point.
They are still up. Although I read a stat
Currently.
today that if property... And there's a few big houses sort of calling for sort of 15-20% falls. If it was to fall 20% this year, it'd actually wipe out most of the bull market in property in Sydney since 2012.
Yeah, so that's what I was assuming. But now people are coming around to that view. You were sort of saying it in 2014.
In a sandwich board, walking down the street, screaming.
Screaming.
About some guy who has a boat when you don't have a boat because
Where
you
is my
invested in
boat?
shares.
Yeah, well, I think it's really... I can't time markets, obviously, and I think it's dangerous to do so. So I really sort of... My view is that the odds of a downturn are much higher than they've ever been before. But also, I think one of the things that is more of a...
I mean, we're in a downturn, though. We're in even Sydney, the great Sydney, the amazing special city that, Matt, I'm not sure if you were joking when you said that it deserves to be the most expensive city.
I think it's a great city.
I think
Love
it does deserve to be more expensive than a lot of other places. But I guess...
But it's coming down. That's the point. And
it peaked in 2017.
Yeah, and auction clearance rates are pointing towards further falls, especially in apartments. I think there are specific little niches. The nice streets in certain suburbs, maybe certain entire suburbs will be a little bit protected because there's a supply constraint. But when you're looking at, your run-of-the-mill apartment in one of the areas that have big apartment blocks, especially now that you've got this Opal Tower thing, which is these residents have been turfed out. I mean, I really feel for those people. They've probably now owe more on their apartments than they have any possible hope of ever selling it for.
It's a real tragedy. All I was going to say was, though, I think there's a middle path here, and I think there's one thing that I think is probably something I'm much more firm on is rather than sort of ongoing bull market or big collapse. I think it's just going to be very difficult to see the gains that we have experienced, say, over the last 10 years. I think it's going to be very difficult for that to continue. And a lot of the argument, and a lot of my argument used to be about these things. You could quote things such as the median price to the median income, which is like a PE ratio. Sorry, it's not a PE ratio.
Sounds pretty cheap.
That's a bad one. Actually, so it's about 12 for Sydney. So long term, it's been about between 4 and 6 in the market. So there's that. There's also gross yields are about 3%.
Yeah,
or so now
I guess that's
in
more like
Sydney.
the PE ratio.
That's a PE of about 33 if you want to invert it. And so on that base, now would you buy a stock at a PE of 33 unless you thought that it was going to have extremely strong growth?
I would if it was guaranteed to go up at double every 7 years.
Well, that's I think that's the rub, and I think that is what is very difficult. And I think one of the things that of the more nuanced sort of commentators and comments that you sort of see out there is that I think one of the things that I've really learned is that the main driver of property prices is availability of credit. When there's a lot of money going around, when things are a lot cheaper in terms of servicing, that is inevitably going to drive up property prices. So we have seen things such as a significant fall in interest rates, a significant fall in lending
Yeah, so what
standards.
do you say? So just to play devil's advocate, I couldn't disagree with what I'm about to say more. But what do you say to the argument that, oh, but you're looking at prices. What really matters is how much people have to pay off their loans. And since interest rates are so low, actually property is really cheap.
Look, I think there is some truth to that, but I think where that's a little bit of a spurious argument is, one, you still have to pay the debt back in terms of the absolute amount at some point in time, even if that means liquidating your property to be able to do that. The other thing is as well is that interest rates move. Yes, they've come down a long way, but it's certainly possible that they could go up. And I'm not going to get into the business of trying to predict interest rates, but when you're taking a loan out over a 20, 30-year period, it's probably not too silly to expect interest rates are going to go up at some stage. So yes, maybe it's more justified under a lower interest rate environment, but the inverse is also true. So when rates go up again, that could very much start to unwind. So I think it is a little bit of a spurious argument. And also, not just in terms of interest rates, but general affordability as well. Like, what if you lose your job? What if we get into a bit of a recession? Again, I don't want to try and get all doom and gloom and try and predict that that's going to happen, but these things do happen. It hasn't happened for 26, 27 years, but they do happen, and it will inevitably happen again. And so when you're dealing with something that you have to service over a period of decades, I think what that does is it just puts you in an extremely risky position. Yes, it's much more justified so long as rates stay low forever, so long as your income, that you use to support your loan is guaranteed, then yeah, maybe that makes sense. But the real world doesn't work like that. Interest rates go up, people lose their jobs, recessions come and go. So I just think it's not exactly a good argument.
So when are you going to be buying, Andrew? Do you think it's going to fall? What's the takeaway?
I would happily buy a house today. I don't have a house at the moment. I've always been a renter. It's been a long-term conscious decision, and that's just because I prioritize equity.
You just like dealing with landlords and that type of stuff.
I love landlords. Yeah. Hi to all the landlords.
That's definitely
out there.
my favorite thing about renting is like the process I have to go through to get the window fixed or something like that.
Oh man! And real estate agents, special hello to you as well. And again, I'm being very mean here because there are obviously
lots of good
exceptions.
ones.
That,
The worst thing about it is I am a landlord.
We've got a really
as well.
good one at the moment.
And I always just get everything fixed. They ask straight away.
Yeah, you're a nice landlord.
Yeah, so look, I guess I thought, look, there's the scene that's where we're at the moment. I think that of all the things.
But when would you buy? This is the real interesting question.
This is my point.
Like,
so my point is
let's just say we've got, I'd say, majority of our listeners have taken a snooze because they all agree with us that property is expensive.
Well, not if they're a representative of the broader Australian population.
When would you buy?
I think, again, I would buy for shelter. So if I wanted a house to live and I was going to live there...
It's a boring answer. When would you buy for financial reasons?
So you would only buy if you decided...
Yeah.
What would be the decision?
As an investment?
I assume you require shelter currently.
I do require shelter. And I think it's different. It's such a different consideration when it comes to shelter. But when it comes to an investment, I'm just not interested at this point in time. Beyond just the average returns and all the rest of it, I think one of the great things you have about shares is they're
But when would you be interested as an investment?
I would need to see yields. I would like to get a gross yield that's around 5-6%. And that sounds crazy. I say that out loud and I realize how crazy that sounds.
5 to 6%.
Yeah,
it's like a normal. That's how it used to be not that long ago, right?
I know, but I'm very conscious of how crazy it sounds in today's environment. So for me, if I started getting yields around that level, I'd start to be a bit more interested.
So we'll see you buying around early 2020 then, I guess.
We will see. I'm certainly not going to short it. I think that's a worry. But what was more interesting is that we in the equity space can't be too smug about all of this, because if there was to be
smug us?
So if there was to be any reasonable property downturn, the Australian share market is going to be absolutely slammed for six. 40%, 30 odd percent of the market is just the big four banks, right? And there's some really interesting stats here. I'm not going to read through all of them.
So you're saying my puts on the big banks will pay off?
If you get the timing right, then yeah.
I think the bigger issue for us is how valuations will be crunched on, those price to sales ratios of 10 or 12 or whatever.
I struggle to see Pro Medicus maintaining a ratio of 100.
Obligatory Pro Medicus mention.
Hey, at least we didn't talk about Catapult.
Hey, we had both. If you're playing at home, please tick off the...
it's a drinking.
That's 2 drinks. They're pretty much guaranteed 2 drinks that you can have every time you play the 3 Wise Monkeys drinking game.
Well done.
So look, mortgages represent well over half of Australian bank loans, like a quarter of their revenues, 30% of their cash earnings. The major banks are exposed to about, it's over $500 billion of investment property loans. It's easy to throw a big number out there. It sounds impressive, but that's about 37% of their mortgage portfolios. Put that in context. Over in the UK, it's about 17%. Over in the US, it's about 10%. And we're also in an environment too, in terms of most other measures, it's what's the other? Interest only. We've got Westpac, for example, has the highest exposure. 25% of their loans held are by interest only paying mortgages. NAB not far behind at 24%. ANZ's the lowest at about 17%. So they're obviously going to take a whack. That's going to bring the economy,
so which ones
the market
should I short?
down with it. I haven't actually dug in deep enough, and I'm not a shorter by trade. But the other thing is, of course, is that there's this wealth effect that's been phenomenal, I think, in driving this really great run we've had in the economy has been everyone's feeling a lot richer. We're all spending a lot. So, the consumer discretionary spending is going to fall. There are going to be real world ramifications for all of this, is my point.
Yeah, we're not looking forward to it, except, I guess, anyone under the age of 40 who hasn't been able to buy a house.
Yeah, that's probably a different dynamic. And again, if it's a shelter versus investment. Let's move on, though, shall we? Gents, who wants to go next?
Over to you, Matt.
All right, thank you. Yeah, so I'm gonna chat today a bit about a sell, work through a thesis that had not worked out too well, and I guess what that looks like. So I guess the first thing I'd say is selling is really hard, and I think that a lot of people don't give much attention to it. So we know there's a good body of research about how retail and individual investors struggle. So there's a thing called loss aversion, where you feel the pain of a loss 3 times more than you feel the joy.
Not
of
a loss
gain.
if I don't sell.
Exactly. If you don't lock it in.
So
for
for
all
your
that-
catapult thesis?
Oh, ding ding.
Ow.
And that's
It's a
3
double
drinks.
bonus round.
You know what? I'm holding those damn things just for the 1 in 100. I told
spite.
you so for another
All right,
couple
back-
of
Yeah,
years.
I'm not sure what that bias is called, but
Back
we'll-
to you, Matt.
you can keep listening. You can
Stick
hear
at
it
the
play out
Claude
over
bias.
time. So that's interesting. There's also some more research recently, which is around how professionals are actually bad at selling as well. It turns out they're actually quite good at buying on average, and that's where most of their attention is, but not too good at selling. And I'm writing it up for my blog, mattjoss.com, so that'll be coming out this weekend, digging into it. But
Excellent.
I thought a good case to dig into around selling was Class, which is a company that I've held before, and which was which was a company that I quite liked. And so just kind of, I guess, walking through the thesis and when to sell.
So let me just, for listeners, the ASX code there is CL1.
Yeah.
What do they do?
Yeah, so they provide a cloud-based software for self-managed super fund accounting, effectively. And they've started doing another one more for not just self-managed super funds, but essentially providing a cloud-based solution to all of the, well, some of the admin that goes with that, which is pretty complicated. And traditionally, like most things, this had been a traditional software model, desktop software, etc. And Class kind of emerged as an early leader in the cloud space. So when we first bought shares back in 2015, I think they had over 16% market share of the total market, and we're winning a really big share of cloud.
Massive.
So the thesis there was that they were winning like 2/3 of all new subscribers to the cloud. So over time, everyone will have to move to the cloud, and therefore they're going to end up with this huge dominant market position, which is really good. But if you kind of step forward to today, things aren't going so well. So Class, over I think 2 weeks ago, released their latest quarterly, very anemic growth, and the share price has come off quite a bit. So I guess a bit of that journey on the way. The key decision point for me is to sell quickly when a thesis is broken.
Yep.
Which sounds quite simple, but a few things go into it. So first, you have to have a clear idea of what your thesis is, which means, if you can, writing down why you want to buy the shares in the first place, and
We
why
talk
you would
about
want
it
to
a
sell
lot
them.
for good reason.
Yeah, so I wanted to add to that. Obviously, you need to know when your thesis is broken, which is a bit of a process required for that. But something I don't think we always dwell on in that sentence that you just said is you need to sell quickly when your thesis is broken. And I think that this is a great example of where that paid off. So I'm just going to let you... no, never mind. We're not on that. But... I keep telling the story, but I think there's a point where this quickly word is really important.
Yeah, absolutely. That's a really good point, Claude. Bought there around, I think $1.85 or something at the time. Ran up very high over the next couple of years. It was growing extremely fast. So it was growing revenue over 50% and profits much faster at that time. It was taking market share and started to become a bit of a market darling. So we bought very shortly after the IPO, ran up to...
420 was the high?
Yeah, 420 was a high, up around the mid-3s. And a lot of stuff was going really well. Like every update was great. But then it started coming off a little bit. So there was a June quarterly number. Every quarter previously had seen bigger growth than the prior quarter. So it had just been continuously expanding new additions. And then for the first time, it fell. And I think that should always be a first kind of, when you see something that doesn't match your pattern, that's when you start kind of asking some more questions.
Let me play devil's advocate. Isn't it just the normal course of any business, even the best businesses, that, nothing's a straight line. You have good quarters, you have bad quarters. Is it a bit of a, there are a lot of factors that go into play. Can't you have really great companies that just miss a beat before resuming that very strong growth? How do you tell if it's just that, or this is really a legitimate change in the trend?
Yeah, great question. So we did decide to continue holding after that first miss. There was some story. There's always a story with it. And I think at the time it was that it was positioned really well for the next quarter to be strong, that it had been some stuff had been pushed into the next period,
Positioned
which we
by
hear all the
management,
time.
you mean? It's like, that wasn't so great, but the next one's going to be fantastic.
Yeah, exactly. And so thankfully, when it's quarterly updates, you only have to wait a few more months to get that information. So that's one. But I think it should also, it's something that does go against what your viewers. So if your viewers that they're going to keep winning very large share and growing fast, then that's something that goes against that. And so thinking back to the original thesis, there's we would sell if there was another dominant competitor that had started gaining share. And during this whole time, I think there should also be something that you monitor to see if your thesis is going well, not just the companies reporting, ideally something else. And there was one huge gorilla in the room called BGL Super, which had something like 50% of the penetrated market, 50 to 60%, very big. And they were our thesis at the time was that they were going to win share off of them, but then something started to change.
All right, so you picked up on that. How did you realize that?
Yeah, very good question, Claude. So I was in correspondence, you could say, effectively with the CEO
He
of
works
BGL
hard.
Super.
This is good research.
So BGL Super was constantly, it was a somewhat antagonistic CEO who didn't really like the fact Class was such a market darling, was constantly putting out updates about how great they're doing. But they were very empty updates for a long time. They were just saying...
from Class?
BGL Super, the competitor.
The main
Okay, sorry.
Class's
Give
main
updates.
competitor would give updates, just press releases.
I wondered if he was upset about Class's updates, or you're talking about
No,
his own
he was.
updates.
I think he was upset that Class was the market darling
Okay.
and on this big valuation, and he was not. So anyway, so he would continuously release these updates, these announcements, and I would kind of email back some of them, being like, "Hey, you haven't given any numbers in this. What do you say here?" And I'd probably get quite a terse, angry response. But over a few months, finally, an update came out, which happened to be the exact same day that Class released some not too good numbers. And that update said that they had signed on 100,000 customers now onto that platform, which meant they were almost as big as Class already on cloud. And they had added, I think, 23,000 in the last quarter.
Okay.
And that same day, this is October 5th, 2017, Class released their numbers. And suddenly the quarterly reporting wasn't shown in the chart that it had typically been shown in.
Oh, you gotta
And
love it
like
when
one
they
of those
change
small
reporting.
little tells. And Matt put me onto it, but I was actually considering the company myself at that stage because it was a bit of a market darling, growing well, recurring revenue, etc. And that was the thing that kept me out of it.
Yeah, I think it's a good. I mean, it's one of those things that can happen sometimes, but there is a pattern. If you notice something that isn't reported, like at the same time, like they report a week later than usual, that's a pretty bad sign. If something's missing, it can be a bad sign. And in this case, it was a huge fall in growth. So the prior September to that added 12,000 customers. This one, they added 6,000 something. So it would have been a very ugly chart, which suddenly disappeared.
I love this story because it's such a good example of how actually if you are an analyst or even just an interested investor who is willing to put a little time in, you can actually get an advantage over other people and react faster. But anyway, take us to the sell, and then I'll...
Yeah, absolutely. So, and again, all this is public. So the information that the competing CEO is releasing is just a press release that goes out and most people aren't reading. And so, that one came out on the 5th of October. Before then, Class had been a company I really liked. I'd even had a fireside chat with the CEO. So it was pretty mentally invested in it, I guess. Spoke to the CEO that day. Wasn't really convinced. They explained that it was just a bad quarter and things would turn around again, and basically put out the sell recommendation that afternoon.
Okay.
So to sell everything of the company.
And I'm just going to chip in there. Like basically, it was a great sell recommendation. The share price is a lot lower now.
Yeah, so it was about $3.10 then, and it's about $1.30 now.
And what do you remember? Like roughly what you sold it for when you were allowed to sell?
So we got out at $3.10.
But like, what did you?
Yeah,
personally-
$3.10. So it would have been a
you
bit
sold
higher than
when
that
you
'cause-
could.
Yeah.
So
Yeah.
I think the really important thing here is that by that quick action, Matt saved some real money because not long after that, a very well-known institutional investor started selling.
Yeah, right.
So the same information flow happened, and I remember noticing this because I was like monitoring it, and they had been buying, and then this like information had come out, and then suddenly they started selling. So, and that's like, I can't remember the exact fund, but it was one of the Wilson funds.
Yeah.
Started selling out, and of course you've got a big, well thought of substantial holder selling. That's going to push the price down, and it's never recovered since. And I don't know the inner workings of their fund or anything like that, but it seems reasonably likely to me that Matt and the fund were reacting to the same information. But if you react more quickly, you can save some real money. And that is exactly true in the buying side as well. There's this sort of nexus between you want to do your work properly, but you also don't want to delay. And I think that a trap that a lot of people, especially, I guess, people that put some time into investing, but they don't want to think about it too much. One trap that they can fall into is that they can think, oh, this new information has come out, I should think about that now. Or they miss it, or they think about it too late and the share price has already moved down. And then they think, oh, well, actually, yeah, this is bad information, but the share price has already moved down. And for someone who's not watching stuff closely, the fact that the share price has moved down is almost the indication that it's a bad announcement. So it's very easy to just buy and hold forever. I'm not saying that that's actually the worst idea either.
Yeah.
But if you're going to be a seller of shares, it definitely makes sense to try to process information as quickly as possible. I've lost count of the number of times I've seen a good sell have somebody get away with significantly more money than a bad sell.
What about the counterfactual, though? What about the person who sells only to see things recover very substantially?
Yeah, so I think that's a counterfactual that people worry about far too much. First of all, like, if you are a good investor that picks winning investments, then if you sell and redeploy that capital, that should on average go up as well. So yes, you could sell something that then recovers, but that needs to be compared against basically your average returns.
Yeah, your opportunity
So
cost.
in my case, the question is not whether I sell something and then it goes up, but whether it goes up more than the average of my portfolio.
Yeah, that's a great point. And and I think it's also just you should be making it as a fundamental decision, right? So it's not just that the price has gone up or whatever else and reacting to that. It's just like a buy. Like if you're wrong because your analysis of the fundamentals is wrong, it's not going to work out as well as if you're right. So I think that's a cool point as well.
We'll move on, but let me try and summarize all of that.
Yeah,
so basically what you're saying...
Yeah.
Oh, sorry.
Yeah, I'll just add, I guess, since then, the thesis of selling, it was still kind of tough because we had been pretty invested in this for a while.
It looks obvious now, but at the time it wasn't so clear, right?
And so the thesis was going to be face growing competition, wouldn't be able to grow as fast. And since then, revenue growth has fallen to just 10% in the last results. Anemic compared to prior highs of account growth. And margins have compressed a lot as well. So you have to spend a lot more to acquire customers and they come in a lot more slowly. And so I guess that combination of things is what played out. If they'd been wrong about that, if this competitor hadn't actually done very well and everything had rebounded, obviously it wouldn't have worked out. But,
Okay. Let's talk about Webjet.
Webjet.
Claude, you bought some Webjet. I think everyone knows Webjet, right?
We
don't need to give a summary of that.
Well, I think, most people, there might be some people whose personal assistants do the booking.
Okay.
I use Skyscanner myself actually quite a lot.
Okay.
Yeah, so explain what Webjet is.
So Webjet is a website where you can go and compare the prices of flights mostly. They have hotels and cars and caravan. They have a few different things you can hire. That's the business that people know, webjet.com.au or webjet.com, I don't know. But the point is, it's got a good brand there and a great business. And so for many years, I was sort of skeptical of this business because
I was too, for the record.
Not all of those kind of booking businesses, those aggregation businesses, they don't always do well. And especially when you've got, I guess, powerful suppliers in the airlines, it never made sense to me why somebody would pay $35.
Is it $35?
In the vicinity of $35 for booking on Webjet when they can get like the exact same price from the airline themselves.
I used to go to Webjet and then book it on the
I'd done that as well,
website.
and I go to Skyscanner and do it. At least like the Skyscanner thing's a bit smoother because what happens with something like Skyscanner is that you just click the link and it takes you straight to the airline's website, and then they sort of sort out the commission between them. So you get arguably a lower price on Skyscanner. But so anyway, it took me a long time to come, and this is important because this is why I'm buying the stock, right? It took me a long time to actually come around to the value proposition for the main part of their business that basically generates all the profits at the moment, which is this direct-to-consumer part of the business. So when I was younger, I would always be very, very cost conscious on all my flights and all that sort of thing.
Before you flew first class all the time.
No, I don't fly first class. And
Private jet.
so basically what happened was I then booked at one point a flight over Skyscanner. The machine that books the flights had given me 2 hours to do my change at Florida. And as people might know, immigration is not exactly the quickest thing ever in the United States. Mm-hmm. On top of that, basically the flight was 15 minutes late from Berlin to Florida. So I'm just freaking out the entire time. Oh, I'm going to miss my connection. I'm going to be stuck in Florida. Like not something I intended nor wanted. I was also meeting my friend in Colombia so we could make connecting flights to some sort of island we were going to. Basically, I was...
So many jokes I could make, but I'm not going to.
Good. I was stressing out.
So on the connecting flight to Colombia, the immigration slowed you down.
No, immigration didn't slow me down, actually.
Okay.
If immigration had slowed me down, I would have been gone because I had about an hour and 10 minutes to get through immigration and get onto my other flight. And I'm running through Florida airport with my
How does this relate to Webjet?
I'm getting there.
He's getting there. He's setting the scene.
Anyway, so basically I'm freaked out. I'm like
stormy
in a high state of like...
And he's high at the airport. So
Okay,
and I'm
on his way to
thinking,
Colombia.
oh God, if I miss this flight, I've got to deal with some sort of... There's no one there. If I call... I Googled around because I knew this was coming. Once I realized there was such a short changeover, I was like, there's a real chance I'll miss this flight. So I'm trying to get in contact with the people I booked it through. Like, nothing exists. It's just all sort of like numbers and you go into the ether and you...
Yeah, because there's no one you can talk to because you've booked through one of these cheap agencies, which seems good at the time, and there's
no one to talk to. You have
there.
no idea what's going to happen. It's just going to become some absolute nightmare, and you're probably going to just end up buying a new flight. As it happened, I got there, with 33 minutes to go before the flight, and the LAN Peru people or whoever it was basically were just like, never mind, and like rushed me through security and got me on the flight, for which I'm eternally grateful and would always fly that airline now. However, the point was that I will never, ever, ever book through Skyscanner or any of those like random sort of cheaper aggregating flights that will do it for you. And then it was compounded by the fact that when I went on and planned the holiday in which I proposed to my fiance, and I wasn't so cheapo this time, I booked through nicer flights through Webjet. And then, of course, we wanted to change a few plans and blah, blah, blah. And it was so comparatively easy. It cost me $50 a pop to like call up Webjet and have someone talk me through my options. And basically the full thing that I would want from someone. I don't want to go into a travel agent anyway. If I can just call someone, which you can with Webjet anywhere around the world, call someone, talk to someone, figure out your options, that's only $50. And if you can figure out yourself on the website, it's even cheaper or even free.
So you're saying it's ostensibly more expensive, but there's a far higher level of service that comes with it.
I think that I thought it was more expensive when I still had my sort of very young adult brain on, that was like travelers.
Before the wisdom of your many years.
I don't think it's wisdom. I think it was just like new priorities where I wasn't like, the mission is to travel as cheaply as possible, and more it was like, the mission is to have a nice time when I travel.
Yeah, that is a
relaxed.
transition that we all make.
I'm gonna challenge you straight out of the gate on that. A lot of the time, so I think whenever you're dealing with any reasonably sized company, you will very, very, very easily, without like 2 minutes of Googling, you will find phenomenal experiences from consumers, and you'll find very, very bad ones. It used to be always the argument whenever it was like Coles versus Woolies. Oh, my local Coles is so much better than Woolies, ergo Coles is a better investment. And so I don't deny your experience for 1 second, but I bet you that had you, for whatever reason, had a bad experience, then that would have colored you in a very, very different way. And what matters at the company at the higher level is not what one person may have had, it's the aggregate of all of those. So what I'm asking is, how is it that you can draw a line from your own subjective personal experience to what the broader value prop is?
That's a perfect question. And the answer is in basically the numbers of the total transaction value that's going through the Webjet platform.
Very nice metrics. Yeah.
And that keeps going up in year after year. And so for a while there, when I was like, why would people ever use this? They don't even want their $35. I was like, why does this keep going up year over year? Then, of course, sort of I grew up a little bit and had my own priorities change, and then I was like, I'm never not using Webjet now.
You could understand it now.
And now I
Yeah.
can understand why their TTV goes up every single year, pretty much. I'm pretty sure every single year. I don't think it's ever gone down.
I'm pretty sure that's true.
Maybe in like the GFC or something it went down. I don't know.
Yeah.
Anyway, the point is...
But that's a really good point, Claude, right? So you're collating different pieces of evidence, right? So you've got all this data from the company TTV, but you're kind of fitting that in with your own experience and other things, right? It's
exactly. Like what was lacking before to my expense, unfortunately, because I should have bought Webjet way years ago.
Yeah.
Is that I couldn't
Shouldn't we all?
understand why
Yeah.
this business was so good. Anyway, so basically,
So they
it's got.
tend to develop a very loyal customer base, I suppose.
I think they do.
Don't even
They've done
bother
it-
shopping around it.
I wouldn't even bother now because not only that, but I want to pay them the $35 so that then I can call them back later and pay them another $50 because I want to change my flights around in this
Okay,
way.
yeah.
And I'm on holiday, and every moment in that holiday is precious.
Mm-hmm.
You know, I just proposed to my fiance. I don't want to spend time even on the internet figuring stuff out.
Mm-hmm.
I just want to call someone up, get it done as quickly as possible, go back to my holiday.
And I think that's a really good point around not even thinking about something else, because I think that's where a brand has value, is it just becomes the default decision.
I'm not even going to
So
price
Claude's had
compare.
that experience, and he's like,
Right.
I'm not even going to bother anymore. And most people who use Webjet they don't like shop around Webjet versus Skyscanner each time.
No.
At some point, they made the decision Webjet's the one to use.
Trusted name.
And that's it. And then, much lower advertising costs, much
But
better margins.
Anyway,
etc.
so this is just part of the story. Now, the question is this good business? I think, there's absolute value there. There's a price at which this absolutely has value. And I think that this core business to consumer part of it will continue to be a good business for many years.
Okay,
Wait. But now, what's happened is over the last few years, I've followed them as they've expanded their business to business.
B2B?
B2B. So this is actually more to do with hotels, ironically, than flights. And it's basically a system that allows mostly independent travel agents, but all sorts of people who might want to provide hotel rooms with hotel inventory. Now, this kind of has synergies from their original business because they're obviously dealing with airlines. Well, airlines sort of are their own real estate agents as well, and they want to have an inventory of hotel rooms. So Webjet, ironically, whilst getting the flights off the airlines, can then supply them with hotel room inventory. So this is sort of like a booking engine that they provide to all manner of people, including airlines. And this took sort of quite some time to really make a lot of progress. The big sort of news recently was that in FY18, they made 5.5 million or 5.4 million profit off the B2B segment. So previously, this had been a loss-making segment that had been sort of carried along by the quite good consumer business that we just talked about, and that's moved into a profit. So this is what I would call a hidden inflection point, because now I try to
Nice.
look for inflection points after Matt taught me about that.
I'm going to challenge you again.
A lot of challenging.
Well, it's a little tongue in cheek, but
Spices
I'm
things
going to do it anyway.
Bring it on.
So yeah, okay, it's undeniable, phenomenal history, good experience, all that kind of stuff. But there's Expedia. There are some very,
we're still on
very,
the
very,
B2C
very
side.
large companies globally that are doing all of this kind
Yeah,
of stuff.
so
History would tend to tell us that tends to be a winner, or the top one or two players tend to win, and then everyone else loses. What makes Webjet going to be one of the top few players globally that's going to allow them to succeed?
So I don't think that Expedia is a threat to Webjet's consumer brand in Australia.
Not in
for
Australia,
the whole
perhaps.
Yeah. So
Yeah.
and that is like the core profit engine.
But we're
that keeps-
nothing. We're
But
25
they're
million.
They're the online travel agent. Like realestate.com.au is the real estate portal. It's
Yeah,
like,
but all of them are going overseas because they've maxed out their
and
growth.
that's
They're
what-
mature,
and
and it's like,
Webjet-
where do we get the growth?
Yeah,
We go
it's
overseas.
true,
And
it's
then
true.
when they go into that pond, now you're going against companies 100 times
So, but
bigger.
what I'm trying to say is that the business to consumer, Australian business to consumer side, that's not your growth story. This is why you're buying. It's massive. This is your downside protection. This is a nice little value.
Base of
This
earnings.
is a nice little earnings engine that's going to keep on bringing in money and cash and profits, which they can then allocate into other ventures, which they may do well, they may do poorly. You see this in Seek, you see this in car sales, you see this in realestate.com.au. These guys have these like quasi-monopolies in Australia that they then use to deploy the cash elsewhere, and they do that to varying degrees of success.
And that B2B is the opportunity.
And the B2B is the opportunity. And finally, after following this development of this after years, I think it looks like it is hitting some sort of inflection point. That's for two reasons. One, it became profitable last year. And look, it has built this through acquisitions.
You're referring to that segment became profitable?
Yes, that segment became profitable. And then also, they recently did a capital raising whereby they bought Destinations of the World, a market-leading B2B travel business that operates a bunch of different in geographies. And basically, the point is that this then, to quote the press release, represents a substantial increase in Webjet's, that's their B2B business, Webjet's scaled and consolidates Webjet's position as the number 2 global B2B player. So just what you were talking about how they're going to be the number 1, number 2 kind of thing.
That kind of
In this B2B web booking thing, on a global level, they are saying that after this acquisition, which they've completed, it is a number 2 player there. So, and it's already profitable. They say it's going to be EPS accretive, and basically that they'll get synergies out as well. So this should boost the profitability of that. So now what I'm saying is we've got one segment that's been profitable for years, another segment that's just become profitable, and they're growing through acquisition, and one that according to their guidance, etc., organically, and according to their track record organically. So basically, growth plus growth gives hopefully a very good runway, and maybe even accelerating growth, since the Webjet segment is off a lower base.
Yeah.
And on top of that, because of this capital raising, that's brought the price down to sort of a reasonable less than 25 times earnings, which basically is not too bad for a good quality company. If I'm right about the inflection point, then it'll be really good. And then on top of that, the directors were participating in the capital raising to a notable degree.
Big inside ownership, right?
Not massive, but you've got.
But they've got some pretty. They're not nothing stakes.
No, right? I'm not really
I'm not saying they own 40%.
I'm not touting it on insider ownership, but there is still something like 20%, I think, of sort of insider holdings. So it's like,
nice, Claude.
Anyway,
I'm pretty interested.
Basically, more what I'm saying is that whilst we have seen insider selling in the past. Actually, it's not 20%, by the way. I think I got that wrong. It's much lower.
Oh, well, it's okay. They've got skin in the game. Hey, so what's interesting about this, and then we can move on, is that you quote a PE of less than 25, which CommSec tells me is 24. The consensus guidance, according to CommSec, which I think comes from Morningstar, is for 54% compound annual growth in earnings over the next couple of years, with dividends almost more than doubling over that period of time. So something is out there. Well, what's the bear case, and then we can put a bow on this.
First of all, it's 13% insider ownership, just to clarify that earlier point.
Okay.
Look, what's the bear case? Look, I think, global recession would definitely hit them hard.
So these are cyclically exposed, or cyclically
just people
sensitive.
stop traveling so much, right? I guess.
Yeah, and I also think just because the vast majority, and this is probably the biggest risk that I would see, is because the majority of their profit comes from Australia. I imagine there's a fair bit of operating leverage there as well.
I have to challenge you again, sir. Good sir.
Right.
Well, no, was it last week or the week before? You were saying you were shorting Media on the basis of an expectation of an Australian recession.
Yeah, so that's what I was
just you're shorting the banks on an Australian recession, but you're going long on Webjet, and then saying at the same time that it's going to be knocked over.
But that's what I'm saying about the biggest risk for Webjet is that this recession thing. Now, that's the whole point of my shorts. Isn't because I'm epically long. I think everybody knows.
You're balancing it out by having some different positions.
Everyone, just to be clear, I've got way more money invested in everything going well than I do in things badly. Okay. I have some stocks, pretty much all of my stocks, for reasons we were discussing earlier, would have their share price go down in the case of an Australian recession, which is why I have then some hedging positions that are supposed to really go a lot
sanity.
down.
Okay, that's a good answer, but I had to ask it.
Yeah, that's fine. But I'm saying, look, this is one of the stocks that would probably get hit even harder than other companies I own that have majority outside revenue, or they're in healthcare or whatever. There's some sort of resilience there. I think Webjet would be hit hard in the case of an Australian recession. But on the plus side, they have got increasing amount of overseas revenue as well,
cool.
including B2C in there as well.
All
So
right. One Webjet, one to watch.
Excellent.
Gents, let's wrap this up. Thank you very much for your time as always. Matt, how can people get in contact with us?
How can they get in contact with us? 3wisemonkeys podcast@gmail.com. Send us some questions.
THREE, not the number 3.
Yeah, correct. Yeah.
Gents, thank you very much as always. I think we've talked enough. Let's just put a pin in it. Until next week, I'm Andrew Page.
thanks for your many challenges, Andrew Page.
Look, I've got to give it as good as I get it, my friend.
Yeah, you do well.
All right. Thanks, guys.
Thanks for
Next
listening.
time. Yeah.
Bye.